In this video, I will share at least 5 stocks and ETFs that are well suited for selling options to generate income. But more than that, every name on this list has solid fundamentals and a strong long-term track record. This means no names like GameStop, AMC or other meme stocks. The goal is to reduce the risk of getting stuck in a bad position and taking large losses. And with that being said, let's start with the first name on the list, SPY or the Spider S&P 500 ETF Trust. Now, there are several reasons as to why SPY is the best underlying for selling options. The first one is that SPY has a positive long-term drift. In simple terms, it tends to move higher over time, even though it goes through periodic crashes. You can see this clearly on the long-term chart. After every major drawdown, whether it was the global financial crisis, the COVID crash, or the 2022 bear market, the index eventually recovered and went on to make new highs. This matters when you are selling options, because if SPY drops and you get a sign, you know that you are holding onto an asset that has historically recovered over time. That gives you flexibility. You can hold, sell calls, or work your way out of the position. This is very different from individual stocks, where a crash can be permanent, especially if the business is fundamentally weak. Because of the long-term upward bias, many income strategies will work well on SPY. For example, here I'm backtesting a bull put spread, where I mechanically sell a 30 delta put, buy a 15 delta put at 45 DTE, then I close at 21 days to expiration, or take profit at 50% of the premium. You can see that the strategy produces consistent results over time. Now, of course, there will be losing periods, especially during market crashes. But if you stick to the rules and stay disciplined, the results will tend to smooth out over the long term. Another advantage of SPY is that it is an ETF. An ETF is far less volatile than individual stocks. You don't have to worry about earnings misses, the CEO saying the wrong thing, or a single bad headline wiping out your position overnight. With SPY, you are trading the market as a whole and not one company. This makes outcomes more predictable and easier to manage, which is exactly what you want when selling options. That said, SPY does have one key drawback, and that is it uses American-style options. This means that if your option goes in the money, you face early assignment risk. This becomes an issue for multi-leg strategies like credit spreads, jet lizards, or iron condors. For example, if you sell a bull put spread and the short put moves in the money, you may be assigned early. If you do not have enough capital to hold the shares, you could be forced into a margin call or liquidation. This is why many traders use SPX instead. SPX uses European-style options, which means there is no early assignment. Even if the option is in the money, it will only be settled at expiration. This makes SPX much safer for multi-leg strategies because you never have to worry about one leg being exercised early. Besides that, SPX also has another important advantage. It is cash settled. Instead of being assigned shares, any profits or loss is simply credited or debited in cash to your accounts at expiration. You never end up holding a large stock portion, and position sizing becomes much cleaner. For example, if this bull put spread expires at maximum profit, you will receive the full $780 premium. But if it expires between the strikes, your profit is reduced, and you only get to keep the portion that remains, which in this example is $348. Because of these features, I personally prefer trading options on SPX rather than SPY. However, the main downside to SPX is size. SPX is 10 times larger than SPY. So if you are someone who's just starting out, it can be capital intensive. So if you want something similar to SPX but more accessible, you can look at XSP. XSP is essentially a mini version of SPX. It is European style and cash settled, but at the same size to SPY, which makes it more suitable for smaller accounts. But is there any cash? Well, yes, sort of. The trade-off is liquidity. SPY has an extremely tight bid-ask spreads, often just 3 to 4 cents. Meanwhile, SPX spread is wider, typically around 30 to 40 cents. SSP sits in between, usually around 10 to 20 cents. That means SSP is slightly more expensive to trade, but the liquidity is still reasonable and the spreads are manageable for most strategies. Quick pause, if you sign up to Longbridge, you can get a 12% interest booster for 120 days plus $18 of Tesla shares when you deposit $2,000. And the more you deposit, the more rewards you unlock, up to $1,366 worth of rewards. Longbridge offers some of the lowest fees when trading Singapore, Hong Kong and US stock markets. On top of that, it is the first platform in the world to offer pre-market US options trading. That means you can react to major news and global events before the regular market opens. Longbridge is also running zero commission and zero platform fees for US options during extended hours. And during regular hours, the platform fee is just 50 cents per contract with no commission. So if you are interested in trying out Longbridge, you can sign up using my link today. Moving on, the next name is QQQ. QQQ tracks the Nasdaq 100, which means it is heavily weighted towards technology and growth companies such as Apple, Microsoft, and Amazon. Compared to SPY, QQQ has higher volatility. So for options traders, that means higher premiums. For example, if you sell an at-the-money put on SPY, you might collect around $10.80. But on QQQ, a similar trade can bring in about $13.58. That's an extra 30% worth of income. At the same time, QQQ is still an index ETF. So while it moves more than SPY, it is still far more stable than trading individual stocks. It also has strong liquidity and tight bid-ask spreads, which makes it easier to enter and exit without losing much to slippage. But more importantly, QQQ also has a positive long-term drift. Over time, it has tended to move higher, even though it goes through sharp pullbacks from time to time. Again, this matters for income strategies, because if you get a sign during a downturn, you are holding an asset that has historically recovered, rather than a single company that may never bounce back. However, similar to SPY, QQQ uses American-style options. This means if you trade multi-leg strategies such as credit spreads or iron condors, you still face early assignment risk. So is there an European-style version of QQQ? Yes, and that would be NDX. However, the problem with NDX is liquidity. There are fewer traders using NDX, which leads to much wider bid-ask spreads. So, for example, while QQQ options have a spread of around 6 to 7 cents, NDX can be around $3 to $4. That makes it expensive to trade and difficult to manage positions efficiently. So, for most traders, it is still better to stick with QQQ. Next up is Amazon. And even though I say Amazon here, it is really more of just an example. In practice, you can apply the same approach to other stocks. The main idea here is to use companies that are fundamentally good. Now, different people may define fundamentally good in different ways. Some focus on future potential, while others look at products, innovation, or industry trends. For me, I will just keep things simple. Instead of trying to predict trends or future potential, I will look at the company's earnings history. If a business can consistently grow its revenue and net income year after year, that tells me that the company has a real business model and long-term staying power. Amazon fits very well into this standard, as its revenues and profits have grown steadily over time. This matters because companies with consistent earnings growth tend to hold up better during market downturns. And even when the stock sells off, the underlying business remains strong. In Amazon's case, its past drawdowns were followed by recoveries as the company continued to grow its earnings. That is exactly what you want when selling options, because even if you get a sign, you are holding onto a quality business that will go up over time. Compare this to a stock that is not fundamentally strong, such as GameStop. Its revenue has been declining over the years, while profitability has been inconsistent. Because the business itself is not improving, the stock does not have a solid foundation to move higher over the long term. That is the type of stock you want to avoid when selling options, because weak fundamentals will increase the risk that if the stock drops, it may never recover. Now, the other reason I like Amazon is valuation. On Guru Focus, if I assume Amazon can grow earnings at around 22% per year over the next decade, the stock comes out only slightly above its fair value. If growth is closer to 24%, it trades much nearer to its fair value. This is especially important for option selling. If a stock is trading close to fair value or even undervalued, the probability of a large permanent drawdown is reduced. That makes strategies like cash secure put, the wheel strategy, and credit spreads far more safe. In contrast, take Palantir as an example. Palantir is a fundamentally good company in the sense that it has been able to grow its revenue and improve profitability. However, its valuation is extremely high. Even if I assume earnings growth of 40% per year, over the next 10 years, the stock still appears to be overvalued by more than 100%. This creates the risk that if the company underperforms even slightly, the stock could reprice sharply lower. In that scenario, selling puts or running the wheel becomes much more risky because the premiums collected may not be enough to compensate for the downside. Besides Amazon, there are plenty of other fundamentally strong stocks that will work well for options. Google is one of them. Microsoft and Apple are also strong candidates, Nvidia and Meta also fall in the same category as well. Though, just be sure to do your own due diligence to check their fair value also, yeah? Moving on, we have United Health Group. United Health Group is also a fundamentally strong stock. Historically, the company has been able to grow both revenue and net income consistently. On Guru Focus, if I assume that the company can continue growing earnings at around 15% per year over the next 10 years, the stock appears to be trading roughly 25% below its fair value today. But more importantly, United Health Group is not a technology stock. This is important because during broad market sell-offs, technology stocks tend to fall much harder. In contrast, the company operates in healthcare, which is a far more defensive sector. Demand for healthcare does not disappear in the recession. People still need insurance coverage, medical treatment, and prescriptions regardless of the economic cycle. Because of this, United Health Group has historically been more resilient during market downturns. That makes it a good candidate for option strategies, especially when selling puts or running longer-term income trades. But what about other non-tech companies such as Ford, AT&T, and Verizon? I often see these names being mentioned as candidates for trading options, as they are relatively cheap and appear stable. But personally, I do not like them as much, as they do not meet my criteria of being fundamentally strong in the long-term sense. While Ford, AT&T, and Verizon may look inexpensive and less volatile on the surface, their financials show very limited growth. Their revenue is largely stagnant, and earnings growth is pretty inconsistent. And without a clear path to sustain growth, these businesses are at risk of slowly eroding in value over time. So even if the stock does not crash, it may fail to recover meaningfully after a downturn, which makes repeated option selling less attractive. For me, the goal is not just to collect premiums, but to do so on companies that are improving as businesses. That's why I prefer names like United Health Group or Amazon, which offer a combination of strong fundamentals and reasonable valuation. This makes them far more suitable for option strategies that are meant to be repeatable and durable across different market environments. So that was a list of some of the best stocks and ETFs to trade options on. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.